Real Estate Tax Planning, Canada, Accountant, Mississauga.
Hi, my name is Allan Madan. I'm a chartered accountant and tax expert in the Mississauga region of Canada. What should you know about tax when it comes to investing in real estate? That's the subject of today's short video. The first thing that you need to know about tax is whether or not you should incorporate it when it comes to your real estate investments. The advantage of holding your real estate investments inside a corporation is that a corporation offers limited liability protection. What that means, in the event of a lawsuit, your personal assets, such as your own home, your automobile, and other personal belongings, would not be at risk in that lawsuit. And it does happen from time to time where a tenant may slip and fall on a property that you own and sue you because of negligence. Maybe the driveway wasn't clean or there was some obstruction there. If you were unincorporated, meaning you held the real estate investments directly, you would not have limited liability protection, and that person who slipped and hurt themselves could then come after you and your personal assets. There's really no tax difference between incorporating when it comes to real estate and owning the real estate individually. The reason being is that the Government of Canada has levied a very high tax rate on rental income, which is 48%, almost the same tax rate for individuals who are in the highest marginal bracket. So if you're earning less than $120,000 per year, you're better off from a tax perspective to hold the investments personally rather than incorporate. If you are earning $120,000 and more, you're tax neutral because you will pay the same tax on your real estate income whether or not you're incorporated. The second thing that you should know about tax when it comes to investing in real estate is something called capital cost allowance, which is also known as tax depreciation. Capital cost allowance represents the wear and tear on the building portion of your real estate investment, and you can deduct that wear and tear on your tax return. The rate for calculating capital cost allowance is 4% of the cost of the building. So let's say you bought a building and land, a townhouse for example, for $200,000, and you hired a valuator and determined that the land was worth $100,000 and that the building portion was worth $100,000. You would be able to write off $4,000, 4% of $100,000 for the building on your tax return. Capital cost allowance is a significant tax deduction that can shelter rental income from taxation, and you should strongly consider it. The third thing that you should know about tax when it comes to real estate investing is what happens when you sell your real estate holdings. When you sell your real estate holdings, assuming you own it personally or jointly with your spouse, is that you will pay capital gains tax. That means the gain earned on your real estate investment, the gain being the sales price minus your purchase price, will only be 50% taxable. So the full amount is not included in your taxable income upon the sale. That means individuals at the highest marginal rate of 46% would only be paying 23% on capital gains tax when they sell their property. So let's say your tax rate is 30%. That means when you sell your property and there's a gain on that investment property, you'd only pay 15% of tax. The other major tax item that you should know when it comes to investing in real estate is how to income split with your family members with real estate investments. For example, let's say you purchase a house that you plan to rent out to tenants, and you consulted a chartered accountant in Mississauga and were advised that you should purchase that house jointly. That way, you and your spouse can share the profits from the rents 50% each on your tax return. That's much better than you buying it individually, including all of the income from the rental property on your tax return. The last major tax feature or tax consideration that I would like to talk about when it comes to purchasing investment properties in Canada is what's deductible. For rental properties, the main items that are deductible from rental income are capital cost allowance, which we talked about, repairs and maintenance, interest, property taxes, utilities, and some capital improvements which can be written off over a period of time. You also may be paying management fees to a property manager to look after your investment property, which would also be tax deductible. If you found this information useful, I encourage you to visit my website, which is shown at the bottom of the screen, http://madanca.com, and access your free report called 20 Free Tax Secrets on How to Beat the Taxman, the URL for which is shown at the end of this video. So go ahead, visit my website, access your free report, and save yourself a ton in taxes. Thanks for watching.